You hear the name IndiaMART and you think Titan, right? A giant in India's B2B e-commerce world. So, what's the deal with its stock? Lately, it's been in a bit of a free fall. Today, we're going to dig into the troubling story the numbers are screaming about this digital powerhouse. All right, here's how we're going to break this down. We'll start with the stock's performance that got everybody worried. Then we'll get to the real problem, the sputtering growth engine. We'll check out how the experts are reacting, ask if the stock is still too expensive, and finally look at what it might take for them to turn this ship around. Okay, first things first, let's look at the raw numbers that really put IndiaMART under the microscope. So the stock drops 1.5% in a single day. You might be thinking, big deal, right? Stocks go up, stocks go down. But see, this wasn't just some random bad day. It was a symptom of something much, much bigger. Let's just zoom out for a second. That one-day drop was actually part of a pretty nasty week, and that week was part of a month where the stock shed more than 10% of its value. And then you look at the whole year, down over 18%. This isn't a blip, folks. It's a clear, worrying downward trend. So a stock doesn't just tank 18% for no reason. There's got to be something going on under the hood, right? What's the fundamental issue that has investors so spooked? Let's get to the heart of it. You know, it really all boils down to one single critical number. It's the metric that fuels their entire business model. Think of it as their growth engine. And right now, that engine is seriously sputtering. 1,500. That's it. That is the net number of new paying suppliers that IndiaMART managed to add in an entire quarter. For a company of this scale, that number, it's shockingly low. It sent a real chill through the market. And get this, that tiny gain came right on the heels of something even worse. In the quarter right before, they actually went backward. They lost more than 3,700 subscribers. That was the first time that had happened in years. Suddenly, the conversation wasn't about how fast they were growing, but if they were growing at all. So what you have here is a triple threat. First, they're just not adding new customers fast enough. Second, they're getting way slower at collecting cash from the customers they do have. And third, they've got a churn problem. Customers are leaving. It's like a perfect storm hitting the very core of their business. So, with all these red flags popping up, you have to wonder, what are the market experts saying? Well, the analysts who watch every single move have definitely taken notice. And wow, the verdict from the analyst community is pretty brutal. Just look at this. Out of 18 analysts, a full half of them are now recommending to sell the stock. Think about that. Only 4 are still optimistic enough to say buy. That is a massive vote of no confidence from the street. And it's some of the biggest names in finance leading the charge. Take Nomura, for example. They didn't just downgrade their rating a little bit. They slashed their price target by nearly 40%. That isn't just a small adjustment. It's a huge red flag signaling deep, deep concern. And Nomura is not alone. Look at Jefferies. They did a complete 180, flipping from a confident buy all the way over to underperform and chopping their price target too. When major firms like these reverse course so dramatically, it puts an immense amount of pressure on a stock. Okay, so this brings us to the big question. For anyone looking at this stock, after falling 18%, is it finally a bargain? Or is it a classic value trap waiting to spring? Well, if you look under the hood at the numbers, the stock still looks kind of pricey. Key metrics like its price-to-earnings ratio are still higher than the average for its sector. In simple terms, it's still being priced for the kind of rapid growth that, well, it just isn't delivering anymore. And that's really the heart of the problem here. Yeah, the stock price has fallen, but it maybe hasn't fallen enough to match this new reality of slower growth. It's like it still has the price tag of a high-performance sports car, but the engine just isn't performing that way anymore. So with all of this going on, how do they pull out of this nosedive? What does the road ahead look like? What does IndiaMART need to do to get investors believing again? Well, the playbook for management is pretty clear. Job number 1, they have to get that subscriber growth engine firing again, period. Then they've got to fix their cash collection problem. They need to fight off competitors who definitely smell blood in the water. And finally, they need a plan for that mountain of cash they're sitting on. So all eyes are going to be on the next earnings report. That is the moment of truth. Everybody's going to be looking for one thing, any sign, any little piece of data that shows their plan to fix all this is actually starting to work. And that brings us to the final critical question. IndiaMART is sitting on a huge pile of cash, a war chest really, with almost no debt. So is holding on to all that cash a sign of strength, a smart and prudent move in uncertain times? Or is it a massive missed opportunity to hit the accelerator and reignite the very growth engine that investors are so desperate to see fire up again? How they answer that question is going to define their future.